Hi everyone, this is CCalle Mercado. Welcome to a new video. Today we are doing a bit of a different video because we are not talking about a company, but instead I'm gonna talk with you about the current market situation and what we can do to perform better in the long term through this offer period. We are going through a lot of volatility, and of course, everyone has an opinion about what the market, what is happening in the market, and what will happen in the market. But as Howard Marks says, it's okay to have an opinion, but you have to be prepared to all the possible outcomes that may occur. So, what should we do in today's market, and what am I doing in this market? First of all, my first say advice would be turn off the news. Um, this morning, I was reading an article about the the headline said, "Don't expect the bottom to be reached soon." After that, a few hours later, we have seen a rebound of about 2% in the main indexes, and I was looking for that article again, but I couldn't find it. So it actually, I was trying to do a screenshot of it to show you in this video, but I couldn't find it. So you have to remember that journalists um, are not trying to give you a superior insight about any topic. Maybe they don't even have it. Instead, what they want to do is feed your greed if you are greedy and feed your fear if you're fearful. To sum up, they want you to read their articles because they make money doing that. So if you can handle the news, you better turn them off. If you think you can handle them, you can read them, but be skeptical about what they say. Second, you have to check your portfolio. In these days, we have seen that crazily overpriced stocks have become just overpriced stock, and stocks that were maybe reasonably priced, now they are somewhat attractive, and stocks that were really cheap are now getting a no-brainer. So just watch the situation, check the investment you have. If you have to rebalance, maybe and hold what you feel more comfortable holding, even what has the best risk reward ratio. And just be sure to check your portfolio and be comfortable with what you hold. What you have to avoid at all cost is getting frustrated, getting fearful, and dumping your stocks. In history, we have seen that it is not a good thing to do to dump your stocks in a moment of drawdown. Instead, it is better to increase your positions if you have cash to deploy, and that will give you a better performance in the long term. That is actually what I'm doing. I'm increasing my positions. So you just have to understand your holdings, to know what their intrinsic values are, and just hold them if you think that they are worth it. If not, you just have to sell them as in any other market situation and look for a stock that you think that has a better risk ratio return, or maybe just a safer approach to investing. In third place, after you have checked your portfolio, you have to prepare yourself. Prepare yourself because you never know what will be the outcome of the current market situation. It can happen that it can occur a 50% drawdown. There is nothing crazy about that. We have seen it a few times in history. So, as Charlie Munger says, if you are not prepared to hold during a 50% drawdown of the market, you shouldn't be in the stock market in the first place. Maybe this isn't for you, but if you think and you want to be investing in the stock market, you have to be prepared to stand a huge drawdown. and see the prices of your holdings fall, because it eventually will make sense and you will recover. But always you have to be prepared to hold, and of course hold good companies, healthy financial statements, and that will be good for you. Finally, in the fourth place, you have to be focused on what you can control. You cannot control if there is a war or there isn't, and if you try to maybe to control that outcome or that input, you will get frustrated, and that isn't good in the stock market. Instead, you can focus on the intrinsic value calculation of companies and to buy them with a margin of safety, and of course to hold good companies and healthy companies. That is under your control, and that is what you should focus on. By the way, you have to do it in every market situation, not just in this situation, but especially in this case, it could be frustrating. So it is better to focus on what you can control. I also wanted to show you what has happened in history, and here is, for example, this picture. I will leave the source in the description. You see that since this graphic is from 1990 until 2020, the average drawdown that was superior to 5% was almost a 12% drawdown. It took 56 days to reach that bottom, and it took 88 days from the bottom to recover the previous level before the drawdown. So you have to know that as an average, it takes 1.6 times the time to recover from the fall. For example, if we look at 2015, we see that from peak to bottom, it took 143 days, and it was almost 13% drawdown. And it took 45 days to recover the previous peak. On the other hand, we see that in 2018, it took 114 days to recover the previous peak. That was a 10% drawdown, and that drawdown occurred in a 9-day span. So again, drawdowns occur, you have to be prepared for them, and you have to be willing to increase your positions, or if you don't have any cash to deploy, you have to be prepared to hold or maybe rebalance to a better risk reward stocks. But in no case you should be dumping your stocks and just going away from the stock market. In this other graphic, again, I will leave the source at the description. If the year ended with a minus 20% return, history shows us, this is the Dow Jones, that if a year ends in a minus 20% return, the next year average return is almost 40%. And if the stock market ends in a minus 30% return, the next year in average is a 22% return. You can see here the different outcomes depending in the previous return. And as you see, the best, it helps you in your investment journey and in your future performance. If you liked it, please like the video and subscribe to don't miss. Thank you very much, and see you in the next video.